Hi, welcome to the valuation dashboard for the week ended the 7th of September. It's obviously been another very volatile week. We had share prices up and down all over the place, and bond yields as well. Once again, rather than sort of focusing too much on the market movements, I wanted to zoom in on a particular issue. We've put out a few things this week. Firstly, downgrading our targets for risk assets, but secondly then also downgrading our targets for the Australian market. I think it's safe to say that we have been in front of the curve in terms of analyst downgrades. What we've been focusing on is the fact that we think 2012 earnings for analysts have been too high, and we've been talking about the need for analysts to downgrade. And this chart here, which we're looking at, is 2012 earnings in the forecast. How analysts have changed the forecasts. So we can see the black line, the small industrials. The red line here is industrials, and since reporting season has finished, we've seen 5% come off the industrials. We've seen a similar amount come off the small industrials, a little bit more. Resources is drifting down, and financials as well has also drifted down in terms of the forecasts. Now the concern I've got though is that while we think we have been in front of the curve in terms of analysts downgrading their needing to downgrade their forecasts, also suspect that what's happened is that while consensus analysts have been behind the curve and I've been in front of them, slightly in front, quite potentially I think I've also been behind the curve, and that we are looking at more significant downgrades that are going to be needed to 2012 earnings. So we've cut out forecast by another 7%. We're looking for a flat earnings for Australian companies in 2012. Now, just to give you a feel for what happened last year was a very similar story. So this is what we're looking at now is industrial earnings growth for 2011 overlaid with industrial earnings for 2012. So you can see that post-reporting season last year, so June, July 2010, we had analysts forecasting about 20% EPS growth for 2011, and then as the year went on, that number got downgraded. We saw the big downgrade around reporting season, similar to what we've seen this year, and then right throughout the year that continued to fade away. Now the concern I have is that this was in an environment with a lower Australian dollar for most of the year. We also had more global stability than what we have at the moment, and you also had higher consumer confidence and business confidence. So I guess the concern I've got is that in a year when the macroeconomic outlook was a lot better, 2011 ended up being with EPS growth down. Why shouldn't we expect a similar result for industrials for 2012? Turning then to margin growth, and sort of following through on this point a little bit further, is this what we're looking at here is the EBITDA, so earnings before interest, tax, depreciation and amortization, compared to sales over the last 15 odd years. Now this is for industrial companies within the ASX 200, and it's the median figure, so the company within in the middle of the range. So we've seen that it has been a relatively volatile series in terms of the percentage that has been translated through to earnings for companies. The thing to note though is these are our two forecast years. We're looking at 2012. We back to that 2007, 2008 levels. So I guess to put it in a longer term perspective, we had lower margins throughout the late 90s, bottomed out around 2000, 2001, a big rise, and then we looked at relatively high margins throughout that 2007, 2008 period. Now the big drop off we had back to 2009, a recovery to 2010, really not much movement through to 2011, and at the moment forecasts have it going back to 2007, 2008 highs for 2012, and then up again for 2013. And in our view, neither of those are particularly likely given the macroeconomic environment, and we're expecting that to be a lot closer to flat than what analysts have at the moment.